Gus is an agricultural fund manager, or XL farmer, as he'd rather be called, based in London. He's a passionate fly fisherman, but spends most of his free time these days playing with toy diggers and toy tractors with two young sons that want to be proper farmers. Gus's topic is, can institutional investment capital provide opportunities for family farmers and new entrants in the UK agriculture? Thank you, Gus.
Thank you and good morning. I wanted to start with a few thank yous. First, to the NFU Mutual Charitable Trust, who've been a very generous and engaged sponsor and a great partner for Nuffield. Secondly, to Nuffield as an organization and as a family for giving me this opportunity. To Mike and Poe and their team. It's not an easy job herding the Nuffield cats, and they've done a great job of that. To my Nuffield Year Group, the 2018 class, who've been a really great bunch of guys and a set of what I know will be lifelong friends. And then finally to my family, to my wife Callie, my two little boys who sadly can't be here today, but they've been through this adventure with a lot of support and a lot of patience and understanding. So I'm a Zim farmer, or at least I was, until 3rd of October 2002, when after 18 months of intimidation, threats, increasingly hostile confrontation, we were finally marched off our family farm at gunpoint by Mugabe's presidential guard, those guys in the gold berets over there. Rather than hang around, we moved up to Zambia the following year. My brother had found a farm. We scraped together some capital. We lived in tents for 2 years. And we basically started again from scratch. That business now, 15 years on, credit to my brother, is producing nearly 10,000 acres of crops. It's employing hundreds of people, and it's exporting grain back to Zim, where the home farm is now derelict. Zambia's challenges were different. They were practical rather than political. We saw more black mambas and more bouts of malaria in 2 seasons than we'd seen in 2 generations back in Zim. But I can honestly say they were a hell of a lot easier to deal with. Once we'd re-established in Zambia, I decided to de-risk the family concentration. I came back to the UK, finished my doctorate at Oxford, and then took on a role for an investment bank in the Ukraine, tidying up a very large-scale farming business in the Wild East, as we got to know it. We then, that led into a role down in South America, again restructuring a very large farming business that covered 2.7 million acres of production across 5 countries and across several climatic zones. Together, those teed up an incredible opportunity in 2012 to build a global ag investment platform from scratch for a Canadian pension plan. And over 6 years, we invested nearly $4 billion into a mix of farming businesses, farmland, farming-related assets, but then also the supply chain. And that culminated in 2016 with a carve-out of Glencore's agriculture business. I keep emphasizing the scale here for reasons which will become apparent. So why Nuffield? First and foremost, it was very prominent in Zim. I'm a family farmer at heart. I'd like to get back farming, hopefully sometime soon, and hopefully here in the UK, which has been a wonderful new home. But also, if we look at the amount of institutional investment that's gone into global ag over the last 15 years, and it is a significant increase, 8-fold increase. Hardly any of that's gone into the UK, and hardly any of that has gone into UK farms. So I wanted to use the Nuffield experience to try and explore that and see whether there were opportunities or business models to try and change that. Where did I travel? I focused initially on a core set of more comparative countries for the topic, but I also leveraged in experience and contacts in Latin America and Southern Africa. Interestingly enough, some really interesting business models came out much closer to home in the Netherlands in particular, and also in Spain and Portugal. So who did I meet and speak to? Primarily farmers and investors and investment managers, but I also spoke to other people in the industry because it was really good to get an alternative and often far more objective perspective from them. I think the other thing is that some of these conversations were well planned and organized in advance, but others, as is the way with Nuffield, were really random, opportunistic, and spontaneous. And an old Nuffield scholar once told me that with Nuffield, doors tend to slam open, and he wasn't wrong on that. What did I learn? Family farmers generally need capital for 5 key reasons. Starting out, growth, increasingly diversification and innovation, and then also for restructuring, which is primarily for succession issues, but sometimes for divorce. And farmers tend to typically fund these capital requirements with debt, very rarely look at alternative solutions. Structurally, global ag is continuing to consolidate. And it's recently slowed down for some reason in the UK. I think this is because of the land price profile, but it's an interesting pattern. Farmers are definitely getting older. I wanted to explore this question because there have been many different opinions around it, but these are operating farmers as opposed to owning farmers. At the 60, an average age of 60, the UK now is the top end of the study spectrum. 15%, less than 15% of farmers are under the age of 35. 35% of operating farmers are over the age of 65. And of that group, 1/3 apparently have no intention of retiring, and apparently 1/3 have no succession plan in place. So some interesting structural stuff that came out of this. I then focused a bit on capital barriers to entry, really aimed at the young farmer, new farmer approach. And in that sense, this exercise looked at an optimal farm size in 2000 and an optimal farm size in 2018. And this is a bit subjective, but it was based on feedback from the farmers I spoke to. The interesting thing here is that not only have farms increased, but the value profile has been astronomical. In the UK, we've had a 400% increase in land values since 2000. You overlay that on increasing farm size profiles, add the machinery in for the extra farming, add the working capital in for the extra area, and the results are astonishing. 640% increase in the UK, 1,300% in Canada. And that just tells me that it's going to be very difficult for young farmers or young farmers to grow and new entrants to come into the mix. Getting to the bottom line, and I concentrate on cash returns because that tends to be the perspective that investors come from. The cap rates in the UK are very low. And this is partly because of the high land values. It's a bit to do with historical lease structures, but these metrics really resonate with investors when they're deciding where to put mobile capital. I mean, some of the other challenges that came up from the investment discussions were to do with scalability and deal sizes, lifestyle versus business culture approach. And then in the UK, the policy uncertainty context is a very significant issue at the moment. Turning the question around, key concerns for farmers are that they generally don't want to risk the family assets, they don't want to lose control, and they certainly don't want to be told what to do. Lifestyle business culture comes the other way around in this sense, and that's often related to time frame and views on returns. And I picked up this inherent mistrust of the financial sector, not surprising because of the GFC, but also because stereotypes persist. And if you do a Google search, even the PowerPoint icon has a pitchfork, a pair of dungarees, and a floppy hat. It's just missing the buck teeth. The stereotypes on the banker's side, not much better. And in my opinion, far more accurate. But you know, despite all of these differences, I found an incredible amount of common ground. Business models all over the place that are bridging this gap. And I think farmers and investors actually have more in common than they realize. Inherently creative, inherently innovative, and inherently solution-orientated. And this mix of business models which I grouped into 8 different categories. We sadly haven't got time to go into them today, or it would be a great cure for insomnia, frankly. But they will be in my report. I wanted to touch very briefly on one, which is a case study. It's a subject of a Harvard Business Review case study set up by a remarkable young woman, Joelle Faulkner, in Canada, where she partners with young farmers that have subscale home farms, and she brings in capital alongside. The interesting part of the model is that there is a 10-year unwind option that either party can create if it's not working. And I think that unwind option overcomes a lot of that trust issue that we were talking about earlier. So I'd encourage people to have a look at that one. So what were my overriding conclusions? Not what I'd set out to, not what I wanted, not what I expected, but I do think that UK Ag at the moment is not currently that well positioned to attract capital, mainly because of the high values, the low cap rates, but also the policy uncertainty. I think structurally we also need to look at this young farmer issue a lot more seriously. But what I did find is that despite these conclusions and challenges, I think we've got a big opportunity here, possibly the biggest opportunity in generations to reset the playing field. As a result, my key recommendations are really policy-centric rather than topic-specific, and I think they'll resonate with some of the discussions we were having yesterday with both Emily and also with Henry Dimbleby. And the first one, I think, is it struck me, we need to agree a clear new vision for UK farming and the food system. There's a lot of debate moving in the right direction, but it needs some key principles to be resolved before that can make ground. And in my view, we need 70 to 75% food security. We don't need 100. We don't want 100. 100's risky, as Henry was saying yesterday. But 50 seems too vulnerable. So why not pick 70, 75 and let's get on with it? I think we need a sustainability core at the principle, as a core principle here. By that I mean quality, not quantity. I mean affordable, not cheap. And frankly, I mean a protectionist environment rather than a free trade environment. We cannot compete with the US and Brazil, and we shouldn't try. Secondly, I think we need to review and revise some of the land market legislation to make sure that it's fit for purpose, and particularly inheritance tax relief and rollover relief. We know why they were put in place, but does it make sense in the current context and format? And then finally, I think we need to walk the talk on the young farmer issue and the new entrant issue. We need new blood in the sector. Programs need proper resources. I didn't see anything that convinced me this is really being addressed seriously. But I think it also means that we need to incentivize the other end of the market. And by that, encouraging, incentivizing succession planning, retirement, and indeed dignified exits from the business. I think that will provide a volume of farmland back into the front end of the market that just helps us to look at a rebalance. Thank you very much.